I think the question on everyone's mind is, if you pre-announced a few weeks ago, how did you then sort of miss estimates for the fourth quarter? What changed?
Great to be with you, Alex. First of all, I want to focus first on the third quarter. We had a great summer. Demand was at historic levels for Delta. We grew our top line by almost 7%. EPS was up 30% in the quarter, and we generated a $2 billion profit, one of the highest profits in our company's history in the quarter. Looking forward to the fourth quarter, we see the revenue momentum continuing to be strong. One of the elements that we addressed with investors a few weeks ago is that we're going to start to see some cost growth in attached to the volumes that we've been carrying. We've grown our business by 15%, by far the fastest growing airline in the industry in terms of overall top line growth, and we have to reinvest some of those costs back in to continue to maintain the service, make sure resources are being deployed properly. That said, Q4, actually our unit cost all in are actually down in Q4 because fuel prices are down. So the net of it, we're reinvesting some of those fuel savings into keeping the product strong for the long term.
Well, fair. So those lower fuel costs helping to offset some of the increased costs, but how long does that actually go for? At some point, are there other levers you have to pull, and what will they be?
Our cost structure is in really good shape. Long term, we've given a plan that we're going to keep our non-fuel cost growth to around 2%. We've been at that level for several years. In fact, the last couple of years we've been below 2%. This year in 2020, we may be above that level by about 1 point. So it's relative. And I think once we have a chance to discuss with the analysts later this morning the context behind the cost growth and what we're doing to reinvest, coupled with the strength of the revenue environment that's really driving the cost, I think people will see next year is going to be another really good year at Delta.
So, Ed, does that mean that, what's your pricing power visibility?
Well, our revenues are strong. In the third quarter, as I said, our revenues are up almost 7%. Q4, we're looking at a similar level, probably maybe closer to 5 to 6% in terms of top line growth. Obviously, next year it's going to remain to be seen. There's a lot to happen with respect to the MAX in terms of how that's brought back into the airline system that may affect some pricing, but generally speaking, I think our revenue picture is very solid.
So I'm glad you brought the Boeing 737 MAX, because there's two pricing power issues with that. The first is that it comes back, so all of a sudden there's just more capacity in the market. That's a general issue. For Delta specifically, you benefited from the MAX being out of service as you had more people migrate to you. What's your strategy for keeping those people?
Well, our strategy is the great work our Delta team does. The customer satisfaction scores we've seen this year continue to set all-time record highs. We're up another 5 points in Net Promoter Score. What we have seen over the years is as customers migrate to Delta, they stay, and they actually bring new customers along with them. The MAX is an open question in terms of when it comes back. One thing I will tell you is that I don't think we've gotten a significant amount of revenue benefit from the MAX being down, because the other airlines have done a very good job of protecting their key revenue pools as they've moved other aircraft in to take the place of the MAX. So when the MAX does come back next year, we'll see how it's reintroduced. But I think a lot of those aircraft are actually going to be replacement aircraft for planes that were extended into the new year. And fundamentally, I think the Delta revenue picture is going to continue to be another solid story.
Well, Ed, it does, though, seem like the investors perceived that the MAX was actually a benefit. We have a chart on the terminal here that I'll walk you through that shows that Delta's actually outperformed its peers ever since the 737 MAX was taken off the market. It's the blue line there that's outperforming its peers. So if the market perceives that, and then you have more capacity coming on, and then you want to keep your customers, that to me seems like you're going to have to lower your prices, which is less pricing power for you.
Well, I think the paradigm in this industry has changed a lot over the years, Alex. One of the things at Delta that we've done is improve the quality of the service and the people and the investments that we're making in the product. And what you've seen at Delta over the last 5 years is our revenue growth story has been very strong. Our customer scores, our market share continues to grow. We're always competitive, of course, but we compete more these days on quality and reliability and not exclusively on price any longer. And that that share, as I say, tends to stay with Delta as we pull it in.
So Ed, if we sort of then look at it from that side, if you want to have sort of a better quality experience, which means you have to have better people, which leads us to the higher crew wages, which are currently rising faster than inflation. You're currently at another round of negotiations. What do you do if those wage increases continue to outpace inflation?
Well, as I said, long term, our strategy is to keep our non-fuel unit cost at a 2% level, which is what we've been doing the last several years. That's what our outlook is going forward. So we're growing, and scale gives you some benefits, some efficiencies. There's productivity as we're bringing in bigger airplanes and in larger gauge for every plane that we take off the system and new planes that we're bringing in, and we're replacing a significant amount of our domestic fleet, particularly over the next several years. We have been and will continue to be. That's a huge source of productivity. The efficiency that we're driving through the airport investments we're making, all of which goes into to be able to counteract any wage inflation we're seeing. So, wages our employees are the very best in the industry. They deserve to be paid the very best. And productivity is one of the sources of that wage growth.
So, Ed, a two-pronged question, but they relate. One is, do you see a recession in the U.S. in 2020? And then to that point, are you holding back any CapEx?
Well, it's hard to call 2020 at this stage, where our crystal ball doesn't really go out all that far. It goes as far as our customers' booking curve window goes. I can tell you for the holiday season, that looks very strong. Our revenues in the U.S., which we're highly levered to, is U.S. traffic and U.S. demand, is very strong. We've been up in the U.S. 8% in terms of overall traffic, and the fourth quarter is looking to be another strong quarter for the consumer. As you get into 2020, questions abound around trade and some economic pressures. I think you're going to see more of that on the international side of our business than the domestic side of our business. We have seen certainly some softness in China and some in Asia, and as well as exit Europe. Some of the traffic has come down, and part of that's also currency effects, not just economic pressures. But the U.S. consumer is very strong, and we continue to be a beneficiary of it.